Welcome to our High Rock Monthly video for June. I'm Scott Tomlinson and Paul Tepsich is with me on the call today. And we're going to start by talking a little bit about what was going on in the month of May in financial markets. I had the great pleasure to visit some clients in Vancouver, which at the sort of the middle of May, and it was absolutely beautiful. So thoroughly enjoy my time spent in Vancouver, and as always, happy to visit with clients there. Paul, month of May, most financial markets were lower. Big dichotomy happening between what's going on in U.S. equities and Canadian equities. It really was not a great month for balanced portfolios either, or for bonds, although there was a little bit of a bounce back towards the end of the month for some of these asset classes. Paul, I know that there's a fairly significant divergence in the majority of U.S. equity stocks and maybe the top 10 to 20. We'll talk about that in a second. I've got a slide for that. But anything you want to comment about, perhaps on the Canadian equity market or preferred shares or any of the others?
Yeah, I think just comment on Canadian equities. Obviously, in Canada, our composite index is largely composed of the big banks, financial institutions, and energy, and none of those things performed very well. I'm not really enamored with the banks right now. In fact, for one new client who owns some, we were fortunate enough to get some sales in April and early May. And energy obviously is had a pretty rough go as of late, even on the back of the OPEC meeting, which came to a conclusion yesterday with a voluntary 1 million barrel a day cut by Saudi Arabia coming through in July. But I think the back half of the year is going to see a lot supply restrictions are really going to come into the oil market, so that should help. But yeah, that's a big dichotomy. You know, the best performing asset U.S. equities, the worst performing asset Canadian equities across the month for the asset classes that we show here, Scott.
Yeah, and now we'll talk a little bit about what's driving the S&P 500, because it is really just a handful of stocks, correct?
Sorry, I think it's NVIDIA was the number one, but and you can I think this chart was May 17th too, and it continued right through the end of the month. So I think there were like 6 stocks that drove the performance of the entire S&P 500 across the month of May, and 494 stocks were down rather substantially, I think. So yeah, real dichotomy. And that brings a good point up, Scott. I read this maybe a month ago, but when you talk about there's such a high level of concentration with these 5 or 6, let's call them mega cap stocks. The Apple, they're all listed here. Microsoft, now NVIDIA is one. Facebook, Amazon, Google, etc. That when you talk about investing in the market, not timing it, and just forget about timing the market, just put your money in the market. It is timing the market, because these 6 or 7 stocks control so much. They control so much of the direction of the stock market. It's stunning. So it does kind of behoove people to pay attention to what these big stocks are doing, because they drive the direction of the market.
Well, and from reading an article in today's Wall Street Journal, the 6 or 7 stocks have propelled the S&P 500 to positive returns, but if you took them out of the equation, the S&P 500 would actually be in negative territory on the year. So that just gives you an idea of how dramatic that is.
Yeah, it's quite stunning.
All right. So as I said earlier, balanced portfolios were actually negative on the month. We use this iShares Core Balanced ETF as one of our benchmarks to monitor how our client balance portfolios are progressing relative. You can use this as well when you look at your portfolio, just to see how it is doing on a relative basis. And of course, if you have questions that pertain to that, we are always here and able to have conversations around this. But just as a bit of a guide, but it was a negative month for balanced portfolios in general. Paul, anything to talk about with any of our special mandates, high yield in particular, perhaps?
No, nothing to really add. They had a pretty much a flat month, but again, they've got a lot of interest income coming in that dulled some of the pain from a few bonds coming off. But one thing was notable in the high yield market is that, as you mentioned before, Scott, in one of our first slides, bonds rose in yield probably the fourth time this year, or a year and a bit, and in a substantial way. But this time, a lot of more interest rate sensitive high yield bonds did not get pushed lower in price, which they had in the past. So they actually held in pretty well. Some of the energy bonds gave up a little bit of ground, but not much. And most of those energy bonds, quite frankly, they're not even going to exist in a year's time. We've had some called from us already. They're just, the companies have taken free cash flow and paid down leverage or debt. So nothing else to add in the high yield space or special mandate space.
Okay, great. Thanks. We'll move on. As everybody knows, it is important to update your wealth forecast because we do want to focus on your long-term goals. So please, as I have recently, I guess at the end of April, we sent out our quarterly reports, and I did suggest that it would be a good thing to get in touch with me. I've had a number of good meetings and conversations with clients subsequent to that. But as a reminder, please, if you have some time, let's catch up on your wealth forecast so that we can make sure we're following our long-term plans. Let's talk a little bit about the economy. Inflation has sort of been at the forefront, Paul, and the Canadian progress on inflation stalled a little bit in the month of May. It was the May reading for April. So, yeah, any thoughts on the circumstances in Canada? And we also have a slide for the US as well.
Yeah, I still think, it was 1 month ticked up a snick, but overall, I think the trend in inflation is still going down. I think the bank will, I do not think, even with a GDP print last week that was stronger than people think, do not think the bank is going to raise rates on Wednesday at all. I think they are done, and they'll eventually cut rates here. And you've got some other slides in here that might help explain part of my reasoning. And I think the next slide is US interest rates and inflation. I think the same there. And even if we went back historically on rate hike cycles, that one we're looking at right now, starting in the early part of 2022, that we've just gone through that pain. There's never been a rate hike cycle that steep, i.e. that much, that quickly. And the Fed just will not be able to hold rates up at 5+%, whatever the heck they're at now, 5 1/8 or something. Well, inflation ticks down darn close to 2 in a few months' time, if I'm right. So we'll see. And again, with the Fed, we've had, they talk a big game. A couple things, like economists are almost always wrong, and number one, and number two, central bankers are always wrong. We've written about this and shown it before, but the Fed always does this. They're too late to the party to start hiking rates, and you can see the blue line inflation, and they'll be too late to the party to cut rates. And they've already broken one thing, and part of that was driving treasury yields higher. Well, some of these regional banks did not mark to market the portfolios correctly, and I think it was more of an accounting problem than an asset problem. But nonetheless, that put a lot of fear into the marketplace and probably the Fed. But something else will break. and it may be consumer, it may be the economy. We're not sure what it's going to be, but something's going to break, and they will cut rates as quickly as they raise them. My view.
And then, of course, one of the big issues, and one of the things that I continue to have conversations around is the debt load on Canadian households and how that burden continues to unfold on the Canadian economy, because even though anybody with a variable rate mortgage or variable rate debt has suffered significantly already, there's still maturing mortgages and maturing debt that has to be refinanced, and it's all being refinanced at rates that are significantly higher when they were first set 3, 4, or 5 years ago. So that will impact the debt servicing costs for households in Canada, and we see it on a regular basis with some of our smaller clients. They're drawing down their savings so that they can afford the higher costs of living, both in their debt servicing and just daily living expenses. And Canadians in general are drawing down their savings. At some point in time, they're going to have to start reducing consumption. And when they do that, I imagine, if hopefully we don't get into a spiraling down situation in economic growth where people are losing their jobs and having to sell their homes as a result. But that's the precarious nature of where the as you said before, Paul, the Bank of Canada is, right?
Yeah, and I think, the governor of the bank has actually been, the way he speaks, he seems to realize this situation that we're looking at right now, circled in Canada. And yeah, I think the bank is well aware of this, whereas the Fed, they continue to what's called jawbone the market and talk very hawkishly about raising rates, and they may pause next week, but don't call it a pause, let's call it a skip, and we're probably going to raise after that. The Fed is taking about $50 billion a week off its balance sheet. I think it would behoove them to continue to do that while not raising rates. And certainly in Canada, the same thing. And I think the bank is, as I mentioned before, I think the bank is, the governor's pretty much said we're done, and we don't want to put any more pain into consumers. And housing is an enormous part of our economy. And if they trigger a collapse, boy, oh boy, it's going to be, as you said, Scott, like a real spiral to get out of. It would be impossible. So something, again, you know what? Something will break. And this could be it, it could be consumers.
All right. Touching on global equity strategy, as we discussed before, we're probably as close to being fully invested in the global equity market or the global equity model as we want to be. And in fact, as I see rebalancing necessary in client portfolios, I'm happy to take sales of equity positions, just because the market, as we discussed before, is so narrowly defined that it's not a market that has a lot of potential enduring strength to it, and there could be a pullback, and we'd be happier to have a little more cash to put to work when that happens. So that's the global equity strategy at the moment. Paul, you want to touch on fixed income?
Yeah,
or tactical. Maybe it's the tactical strategy.
Tactical. So we didn't actually have really any trades of significance in the tactical model, but I'll just mention a couple things. Two stocks that are in somewhat of a similar situation, but dissimilar services or businesses. AutoCanada stock we own, we've mentioned it before. It put out a first quarter that drove the stock lower, and a bit lower than where we bought it. We were pleasantly on side after we bought it. Then after the quarter, it drove it lower. But I would note on the call that the first quarter conference call, the CEO said, you know, their stock's trading at a multiple of enterprise value to EBITDA or cash flow of roughly 4.5 times. And he said, you know, buying new car dealerships, they're one of the largest conglomerate of car dealerships in the country, and the only publicly traded one. And he said, you know, our stock's trading at 4.5 times. We've got 150 million cash on the balance sheet, and new auto dealerships are trading, you know, 6.7 to 10 times multiple. He said, obviously, we're not buying more dealerships. We will be buying our stock back. In 2022, they did 2 large stock buybacks that are called substantial issuer bids. That's sort of a one-time shot where they buy back much more than 10% of the stock. Anything 10% or under is called a normal course issuer bid and goes on for an entire year. So, and they were big. The stock is volatile, and because it's getting thinly traded, there is one large holder that I believe is just under 25%. So it's pretty volatile and thin, but I do think at some point here we're going to see the company announce another substantial issuer bid. Another one that's been hit down in a similar situation, they have a fair bit of cash on the balance sheet right now, and constantly bringing new cash in every quarter or every month, is Yellow Media. And they did something even bigger. They did a plan of arrangement last August, I believe, where they bought back a third of their stock at a fixed price. I think it was $12.56. Today, the stock's trading at $12. They they have no leverage. It's unbelievably cheap. And I do believe the same thing. They're going to either announce a special dividend on the stock, or do another substantial issuer bid on the stock. They've already increased the dividend, and the thing yields 6.7% yield. And there are not that many companies I know where I can forecast cash flow like I can on this thing. So I've got a pretty robust model and a discounted cash flow model on this, and it's extremely cheap. Away from that, Baytex Energy stock continued to kind of basing out a little bit, but as I mentioned before, energy's, you know, oil has been trading off a fair bit here, even with this Saudi Arabian cut yesterday. Source Energy bond continues to be well bid. I think the company's got to come in and start buying bonds. Well, they're trying to buy bonds. I don't know if they're going to succeed. Still like that position. The only other thing to add is Sherritt. I would note to people on Sherritt stock, because we do own the bonds as well in a very small amount, that the price of most commodities has been hit down very hard in May. The US dollar went up, not hugely, but it went up a fair bit in the month of May. And of course, the price of all commodities drops. And the price of nickel got darn close to 20,000 a ton on the London Metals Exchange. And last summer, when it was at 20,000 a ton, the stock price in Sherritt was at 31 cents. Today it's at 50. And the reason being is twofold. Number one, they paid down a substantial amount of debt last year through tender processes. So that took out a ton of risk in the name. And number two, they did a phenomenal transaction with their Cuban partners, where they are meant to receive $78 million Canadian per year from Cuba over the next 5 years. So even with the price of nickel coming off, they're going to have $78 million worth of cash coming into Canada per year. So that is pretty substantial. And if we were able to buy more stock at 50 cents, we would. And we're working on that as well. Anyway, that's it for the tactical model, Scott.
And just before you talk a little bit, or if you have anything to say about fixed income, I just would like to bring to the attention of clients that in a number of reviews that I've been doing more recently, we've been drilling down into the difference between the current market prices of bonds and their actual maturing values. And as it is, our strategy tends to be to hold most of the bonds that we own to maturity. We know that those bonds are currently that are currently discounted are probably going to appreciate in value between now and when they mature. But that discount is adding to a balanced portfolio with about 40% fixed income. It's adding about 3 or 4% in increased value. So when you look at the current value of your portfolio and you see the performance, if you have a 40% fixed income bond portfolio, you are going to see the potential as bonds move towards maturity of a 3 to 4% increase in the underlying value of those bonds. So that's a conversation that I'm having, and I'm really happy to drill deeper into this to show these situations to our clients if they wish to see it. But anyway, Paul, I'll just let you go on from here. Paul?
Sorry, Scott, I left it on mute. I said, that's a great point. It's called pull to par. Bonds mature at par. So if they're trading at 90 cents on the dollar and it has 3 years left to maturity, it's going to pull to par to 100. And you're going to get, correct me if I'm wrong, Scott, but you could also mention that we're going to get 10 points of capital gains. Like if your adjusted cost base is 90 cents on the dollar, and when it matures at par, that 10 points is capital gains, and you pick up the interest income over those 3 years as well. So it's very good for including non-taxable accounts. So it's a bit of a win. And we do own quite a few of those bonds, specifically some of our high yielding names as well. But given what happened with interest rates last year, we're owed a couple favors from the fixed income market. Just 2 things to mention. The Canadian dollar really didn't moved across the course of the month, but it began and ended roughly where it was. So it didn't have much of an effect on our total portfolios. And the only trade we did was we sold a forward bond in the high yield portion of the fixed income model. And we extended term 1.5 years, 2 years to another forward bond. So we just did what's called a switch trade out of 2024 maturity into 2026 maturity.
Excellent. Okay, thanks for that. And that's it. So as always, we want to thank you for taking the time out of your busy schedules to tune in. We want to always be focusing on your portfolios, but we do want you to contact us if you have any questions or concerns. And of course, we're always available, so please feel free at any time. However, on that note, on behalf of myself and Paul, I'm going to wish you all a wonderful rest of the summer. We will be back in July to update you all at the beginning of July, but until then, take care.